Tired of hearing that dividend stocks are boring and slow? Well, get ready to have your mind blown. In this video, we'll dismantle the biggest myths surrounding dividend investing and reveal the exciting growth potential it can unlock. You'll see real-world examples of how dividend stocks have outperformed the market.
The answer is I do believe in dividends in a great many situations, including many of the ones, companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain.
Fueled powerful passive income and become the secret weapon of savvy investors. All right, let's break down how dividends and stock prices generally work. Imagine a stock is selling for $100, and on March 1st, they tell everyone they made an extra $5 for each share in cash. They want to keep $1 for future business stuff, and they choose to give the other $4 per share as a dividend to the folks who own the stock on March 11th. Now, it takes 2 to 3 days for stock deals to get sorted, so if the special date for dividends is March 9th, you got to grab the stock by the end of March 8th to get the extra money. Here's how it usually affects stock prices. On March 8th, the stock is expected to be valued at $105. This breaks down with projected future earnings at around $100, $1 in fresh retained earnings, and a $4 dividend set for shareholders. On March 9th, the stock goes ex-dividend, meaning new shareholders won't get that extra cash, and they won't pay more for something they won't receive. So on that day, the stock should trade for about $101. Considering future earnings at $100 and still have that $1 in new retained earnings. Essentially, on the ex-dividend day, the stock price should drop by the exact amount of the dividend. Of course, these are general numbers, and various things like company news can also affect the stock price, making it go up or down. But generally, this is how the market deals with dividends in relation to the stock price. So, when folks say the dividend comes out of the stock price, they're spot on. It does. It's definitely not free money. It's the earnings a company made that they're handing back to their shareholders. But that's not the whole deal. The main thing between a company that pays dividends and one that doesn't is that the shareholders get a say in how they want to use their piece of the earnings. Let me explain. Take Company A, the one we just chatted about. They made an extra $5 for each share, and they're keeping $1 for the business, which we still own shares in. They're giving us $4 for each share we have, and we can do whatever we want with it. So if we need it as income, we can do that. If we want to invest it in something new, we can. Or if we believe in the same company, we can put it back there. Of course, you'll pay taxes on the dividend, but taxes are the price you pay to have the choice to use the profits however you see fit. That's the cost of having options. In Company B, they don't give out dividends, opting to keep the full $5 in the business for future growth. As a shareholder, you still have a claim on those profits, but rely on the management team to make wise choices in allocating them. It's not about one being better than the other. It's about who decides what happens with your share of the company profits, either you or the company itself. Both companies might also choose to do share buybacks with extra profits, increasing shareholders' overall stakes without usually incurring taxes. However, share buybacks are essentially the company deciding on your behalf. If you think share buybacks are always superior to dividends, consider examples like Facebook or Meta in 2021, where a massive $40 billion in buybacks at $300 to $335 per share didn't prevent a subsequent drop to $90 per share. Dollar General also faced a similar situation, buying back shares at $200 to $250 per share, only to see the stock dip to $109 per share within a year. Like everything, there's no one-size-fits-all. It depends on each situation and whether you want the company or yourself to determine how profits are used. When people claim that paying dividends signals a lack of growth ideas, it's not necessarily true. A company consistently paying and increasing dividends reflects a robust business model, showcasing stability and the ability to generate investor-friendly cash flow. It serves as a gauge for assessing investment reliability or volatility. Growth-oriented investors argue that companies paying dividends might be running out of growth ideas, resulting in slower growth or lower returns. However, investing doesn't happen in a vacuum, and equality between companies is rare. Consider Peloton, whose investors in July 2021 witnessed remarkable growth, but now face significant losses, with the stock plummeting to less than $5. While extreme, it highlights the nuanced reality. Giants like Google and Amazon, now paying dividends, reinvest profits and achieve phenomenal success. Your perspective depends on your timeline and each company's unique narrative. If we look at the total returns of the past 5 years for companies like Google, Amazon, Berkshire Hathaway, McDonald's, and Starbucks, the results might surprise you. Google leads with a 115% return, while the next best performers are McDonald's and Starbucks, both dividend payers, with returns of 80.86 and 77.09 respectively. Interestingly, they outperformed Berkshire Hathaway and Amazon in total returns over the same period. This challenges the idea that retaining earnings for growth always leads to a higher stock price. Sometimes having a solid business that consistently generates cash can yield a better overall return, depending on the specific business. Now, let's address the theory that dividends are unnecessary because investors can sell shares when they need cash. While it's technically true, relying on selling shares makes you susceptible to market timing and factors influencing the current stock price, impacting tax consequences and access to funds. Dividend stocks offer the advantage of predictable future cash flows, especially when investing in stocks that consistently pay and increase dividends. While stock prices fluctuate, investing in dividend companies provides a stable or growing cash flow, regardless of market ups and downs. Planning cash flows in advance enables adjusting to income needs without relying on specific stock prices when funds are required. Investing in dividend-paying companies reflects a true business owner mindset, akin to being a part owner of the company. Owning shares in Starbucks or Valero is like having a stake in a coffee shop or an energy company, respectively. Unlike selling shares for income, dividends provide regular cash every quarter. While selling shares is an option, it introduces additional variability into the process, requiring a different mindset. Now, what about the idea that growth stocks always outperform dividend-paying value stocks in the long term? Discussing this on an individual stock level depends on the specific companies, making it challenging to provide a general answer. Even when considering a group of stocks, success depends on the performance of the chosen companies. Let's take a broader view by comparing general growth and dividend indices over time. Using 3 Vanguard funds, or ETFs, VAGAX, Vanguard's Growth Index Fund, VIG, Vanguard's Dividend Appreciation Index ETF, and VYM, Vanguard's High Yield Dividend ETF. We analyzed over 25 years of data until January 2007. The growth funds significantly outperformed, boasting an 11.37% compound annual growth rate, compared to 9.07% for the Dividend Appreciation ETF and 7.77% for the High Dividend Yield ETF. The growth fund's design and the influence of multiple zero interest rate periods in the 25-year span contributed to this outperformance. However, the key takeaway is that we don't need to favor one approach over the other. Investing in growth and dividends each has its pros and cons. While growth generally outperforms value over time, it comes with emotional ups and downs. A recent study found that 66% of investors have made impulsive or emotionally charged investment decisions they later regretted. Emotional investing impacts 85% of Gen Zers, more than other age groups. A study of 1,100 investors highlights emotional challenges in investment decisions. Consider Facebook's journey. Bought at $166, it dropped to $153 within 1.5 years, then rose to $380 and fell to $90 after 4 years, only to recover to $298 after 5 years. While it's tempting to claim you'd hold throughout, the reality is harder. Over a short 5-year period, volatility is evident. Dividend stocks with consistent payouts provide a steady income, reducing anxiety during price fluctuations. Maintaining focus on a growing income stream helps prevent overreactions to temporary stock drops, emphasizing a crucial point in investing. Our distinct investment goals and personalities greatly influence our investment results. Saying, "I'll just invest in growth for 30 years," is challenging amid market swings and daily news cycles. Focusing on long-term goals is crucial. Building a steadily growing dividend income stream helps achieve that. For optimal results, I recommend a mix. If you have a 30-year timeline, include exposure to growth stocks through a retirement account. Pair this with a dividend portfolio for a reliable long-term income stream that aligns with your life goals.